My name is Matt Davey. I'm the Chief Executive Officer of Tekkorp Digital Acquisition Corp, a special purpose acquisition company. We IPO'd back in October 2020. So the special purpose acquisition company structure has evolved quite a bit during 2021. The actual framework for this type of entity has been around for over a decade. But what we've found is a massive explosion in popularity, really starting from the middle of last year, in 2020, into now. It's a fairly sophisticated product, so it involves a number of kind of key components. First of all, when you IPO a unit, which comprises typically of a share and some percentage of a warrant, and you can choose what warrant percentage you would like. Some come out with a half warrant per share and others at a third warrant, etc. So the treatment of that unit has come under some scrutiny from the SEC. We've worked with them and our legal counsel to make certain that we use the right accounting treatment, but they have modified their views somewhat between an asset and a liability around the warrants themselves, which has had no impact whatsoever in terms of the operations of the company, the cash in trust, but it has had an impact in terms of how we present our accounts as we do our SEC filing. Outside of that, the overall market has viewed the SPAC segment with various levels of enthusiasm. At the start of this year, in Q1 effectively, there was incredible enthusiasm behind the product where units, shares, warrants were all bid up to extreme values, which is probably unjustified. And then towards the end of Q2 and into Q3, they were sold off in a somewhat extreme fashion. Again, probably unjustified. The special purpose acquisition company, the stock itself should be really stable. It's all backed by cash held in trust. It really shouldn't move much around that until such time as the sponsors announce a definitive agreement and tell the market what their target is. And at that point, the market should take a view. So we've watched quite a bit of volatility in terms of enthusiasm, but also some changes in terms of how the SEC have viewed the product itself. Yeah, our view has consistently been that SPACs are a great product and a really good vehicle for a certain segment of companies. They're not the solution for every company. And just to remind everyone, there's typically three routes to getting public in the US. You can either do an IPO, where you list your company out at the gate by yourself. There is a direct listing where you list again, but you don't raise any capital as part of that process. You literally just list your shares on the market. And then through an acquisition with a special purpose acquisition company like Tekkorp Digital Acquisition Corp. So there are three different models that they all have their kind of pros and cons. SPACs, in my view, are particularly attractive to companies that are looking to go public, that have great recurring revenue now, great growth rates in the future, and would benefit from speed and from the ability to be able to select their investor group, design their board, and give a lot of certainty to what the post-public company looks like. No, I think when we look at the number of SPACs that are focused on the sports betting and gaming industry, you're literally talking only a couple of dozen. And when you think about what's the competitive set that we're operating in, you need to think about all the private equity shops in the world, all the venture capital shops, and all the companies looking to go direct via an IPO. That's the universe of potential targets that SPAC owners will be looking to compete with. So we think that there are literally 300 to 400 high quality companies worldwide in the online sports betting and gaming industry, and only a fraction of those are currently targeted by SPAC sponsors. And we think that there's at least another 5 or 10 years of this kind of healthy process of bringing some of these private companies into the public capital markets. One of the key drivers here has just been the rate of growth, particularly in the US market, that is driving operators and suppliers to need to compete and gain access to capital. And our view has always been that probably one of the most efficient sources of capital to help drive growth is the capital provided by the public capital markets, particularly the US markets. And so we think that driver is going to remain. We also think that there will be strong ongoing and enduring interest from institutional investors and retail investors that would like to own a piece of these fast growing and highly attractive sports betting and iGaming companies. So we think that combination between need, both from a company perspective and an investor perspective, will be enduring. We think the dynamics around the growth in the industry, the secular drivers behind this adoption to digital and mobile, along with this expansion of sports betting and iGaming in the US, create just a really great environment to bring companies public. And we think that demand will be around for many years. We think just the small number of listed companies we have today really doesn't give investors access to the full breadth of interesting businesses that they could likely get over the next 5 to 10 years. It's a great question. Will they remain popular? I think their popularity will ebb and flow. What I would like to see, and it doesn't mean that'll happen, what I'd like to see is less noise around SPACs themselves and more focus on high quality companies that have enduring competitive moats around their business that benefit from being public. So there's real, clear view as to sources and uses in terms of why they should be public. And then investors getting behind those businesses and supporting these high growth companies with fantastic entrepreneurs and great competitive products that they're bringing to market. What we'd like to see less of is the noise around the SPAC market itself. There's nothing particularly special about SPACs. They're literally just a great source of capital and a clever way to bring some companies public in a short period of time with the right kind of capital structure from day one. So we'd like to see less noise, less focus on potentially the SPAC sponsors themselves, and more focus on high quality companies that should be the target of these SPACs as we bring them to market. That would be great. And then obviously we'd like to see the accounting and financial treatment behind those businesses settle down and be well understood by investors on both sides of the IPO, and less volatility through the de-SPACing process. Right now, we're seeing a lot of volatility, and that's not necessarily good, particularly for retail investors, but also institutional investors.